it's time to talk about the famed real estate crash. When did real estate prices actually bottom? What are real estate prices doing right now? And could real estate be the cause of the current recession or not recession? Let's talk about that in this video. First, let's understand where we came from. We came from interest rates below 3% on a 30-year fixed rate mortgage, sitting around 2.75%, with over 90% of individuals having an interest rate of under 6%, over 70% having an interest rate of under 4%. Most Americans are doing pretty dang well with their home mortgages. And what makes America different from other countries, and America today different from the past? Well, it's what I just described. In most other countries, you get what are known as 5 or 10-year fixed rate terms, which means you have to refinance every 5 or 10 years, and you don't get this 30-year fixed rate mortgage. That increases the pressure to sell or to refinance, and if you can't refinance, then to sell or make the payment. If you have to make the higher payment, then you end up getting hit as a consumer. In America, with the 30-year mortgage, we've actually been relatively resilient from this sort of pain. If you look at the housing market in the United Kingdom, it's in the doldrums, down 20+%, the same thing in Canada, and it's still down by those levels. If anything, in some cases, it's actually worsening. Whereas in the United States, even though interest rates are going higher, home prices aren't actually worsening anymore. And this feels very different from the last cycles. In the last cycles, and it's always dangerous to say the proverbial this time is different, but in the last cycle, we had a massive economic recession led by the housing market. And that was because most individuals were actually on variable loans. In other words, as interest rates went up, they immediately, or within 6 months, had to start paying higher interest rates. We're introduced to more expensive housing using teaser loans or the inability to actually qualify for loans using non-qualified mortgages, which now most mortgages are qualified. Dodd-Frank ability to repay requirements exist today for both qualified mortgages and non-qualified mortgages, whereas back in 2005, 6, and 7, you did not, as a borrower, have to have the ability to repay. You could be a teacher and get a loan for a $1.5 million house because you said you could afford it. You didn't have to prove your ability to repay. Massive difference. And again, most did not lock in the 30-year fixed rate mortgage, whereas today we're locking in the 30-year fixed rate mortgage, which potentially establishes the idea that the housing market crash may actually be entirely avoided as long as rates do not continue to stay at this level, which they may, for too long. And that is because we are preventing price discovery. By preventing people from selling, we're preventing inventory. By preventing inventory, we keep pricing stable because people continue to buy properties based on comps. And there's no forced selling of distressed properties because people's mortgages are going nutty. Instead, people's mortgages are affordable, not new mortgages. New mortgage affordability is off the charts, but the number of buyers actually financing homes at these new mortgage levels is extremely low. You're down 30% from last year, and even last year's levels were down from the year before that. So what's actually happening to prices? Well, there are two pieces we need to cover. There's a Wall Street Journal piece, and there's a Morgan Stanley piece. And what I'd like to do is start with the Morgan Stanley piece. Morgan Stanley's prices reapproaching peak. Well, this is really interesting, and we should analyze this. The way I'd like to start analyzing it is that I actually like to look at the chart. And so what you can see is, you can see here pending home sales down 14% year over year. Some markets are down even more than that. New home sales are up. That's great. This tells us about purchase applications, the number of people going for mortgages, the number of people actually buying. We know those numbers are down, and that's fine. But what we think is most interesting is actually the following. Listen to this. I'm trying to find exactly where it is. Where is it? Here it is. We expect to return to positive prints with next month's Case-Shiller Real Estate Home Price Index actually showing a positive read for real estate home prices on a year-over-year level again, with our forecasts now showing a base case of a 0% gain in real estate prices and a bull case of a 5% elevation in real estate prices. Why do they believe this? Well, they believe that real estate prices basically bottomed in March. I'm trying to find exactly where that chart is. We're going to end up finding it. But anyway, they believe that real estate prices had ended up bottoming in March of 2023. We'll find it in a moment. And when real estate prices bottomed in March of 2023, they actually started recovering from March of 2023. So you had this decline from about May of 2022 to about December to March. So December 22 to March of 2023. And since then, you've actually started having a recovery. And that recovery is really weird because so many less homes are actually selling because there's so many fewer buyers. And this is having a really weird dynamic on supply. You're actually in many markets seeing the months of supply of homes go up, not down. Now that's crazy. People will say like, Kevin, that's crazy. What do you mean the months of supply is going up? There are way fewer homes on the market. That's true, but there are also way fewer buyers. And that does still create a risk for the real estate market. Remember, quick math, how this could work. If there are 100 homes on the market and 20 homes sell every single month, then when you divide the two, you have 5 months of inventory on the market. If now you have 70, or let's make the math easy, let's go with 80 homes on the market, so 20% less inventory, but you have half as many buyers, you actually now have 8 months of housing inventory. So housing inventory actually went up by over 50% as your buyers dropped by 50% because inventory is down 20%. Isn't that crazy? It is. And that is a risk factor for, yes, prices, but only if price discovery is forced. Forcing price discovery is usually done by short sales, foreclosures, and distressed sales. We're getting very few of those right now. In fact, in a lot of markets, specifically like in the San Diego market, you're actually seeing substantially more competition now than you saw at the beginning of the year, implying actually a market where buyers are saying, okay, like the worst is behind us, it's time to continue buying. And in a weird way, you're getting asset-rich home buyers coming out and buying more properties, not less. The Wall Street Journal just released a piece indicating that the fall in home prices may already be over. Home prices aren't falling anymore after declining on a year-over-year basis for 5 consecutive months. The longest run in 11 years, home prices rose in July. This aligns with the idea that the bottom was probably somewhere between March and June. Somewhere around there, March and June of 2023 was probably the bottom. Although December was potentially considered a bottom in some markets. But somewhere in that 6-month region seems to have been so far where that inflection point is. Which I've been waiting for that inflection point, and that's one of the reasons we've started buying with HouseHack, that we're cautiously buying, right? We're not like, oh my gosh, we need to blow everything, because we actually don't think that real estate prices are going to escape. We think real estate prices will probably be somewhat volatile and relatively more neutral. We don't see a big crash, just like we don't see a big runaway. That's just based on data we're looking at right now and what we're seeing in the markets. I combine data with actually being in markets, talking to realtors, and seeing what the competition is doing. There's nothing like having a read on the housing market, like actually writing offers and seeing what deals you're winning and what deals you're losing. That gives you a great perspective for what is actually happening in the market, not what the Twitter trolls want you to believe is happening in the market. Because I'll tell you, the Twitter trolls are really good at taking things out of context. And we could look at some of these things for taking things out of context and potentially add some context to some of the things that are being said, mostly because generally what you find is that the folks on Twitter are going to take charts that tell you about what housing affordability is doing for new home buyers who are financing all of their homes. But those charts generally completely forget that there is a very high likelihood that you could end up with a greater wealth gap than you've previously ever had before. And that's scary, and it should be scary for people. It's sad. We don't want the wealth gap to widen, but it actually can widen. And this is why when you see charts like the buying versus renting charts, like this, here's a buying versus renting chart. The only reason this chart exists the way it does is because interest rates are as high as they are right now. But if interest rates normalize, which we expect them to, you might actually end up seeing the monthly cost to buy a house be lower than the accelerated price of what rents have done. Notice this, if you drew a trend line on the increase of rent prices, notice this inflection point in rents right here. This inflection point in rents is driven by fundamental increases in rents and wages. Whereas this is driven by artificially high interest rates right now. Yes, we've previously had artificially low interest rates, but this is artificially high right now to deal with the money printing that occurred. As interest rates come back down, you probably will actually see the monthly cost to buy a house lower than the cost to rent, which will be pretty remarkable. And so that's why asset-rich buyers are actually buying now, because they expect that will actually be a tailwind to home prices in the future. And it might take a couple years. It might take 3 years for rates to come back down. That's okay. But anyway, the Wall Street Journal suggests here that the residential real estate downturn is turning out to be shorter and shallower than many housing economists expected. Scarcity is a big reason high interest rates have promoted homeowners to stay put rather than buy new homes or take on expensive mortgages, resulting in an unusually low inventory of homes for sale. Many potential home buyers have given up their search because mortgage rates are just simply too high at a 2-decade high. Sure, mortgage rates are ridiculous right now. 7-8% is very, very expensive right now. In August, prices in 30 of the 50 biggest markets actually hit a record high, according to Black Knight. Now, you also have to keep in mind, you have to add inflation, an inflation adjustment into some of these prices. You know, you look at, oh, here's the chart. This gives you sort of your chart. Yeah, look at that. So it kind of shows you a bottom, March to May. This is what I've been looking for. And here's your inflection point, which you're finally reiterating, right? Now, that doesn't mean you can't be volatile. That's why you want to be careful, but you want to watch this. But what's fascinating is, if you look at an $800,000 house today and you take off, let's do it the other way. Take a $650,000 house and you add 20% inflation, which we've had. That's a $780,000 house, nearly $800,000 house. So it's kind of like 800 is the new 660-ish. It's scary, but it's just the way it is. You kind of have to like reprogram our mindsets. It's bizarre. But anyway, and it's probably, I mean, the inflation probably isn't going to go away. You know, it's the same thing for grocery prices and some of the other prices that we're just dealing with. And, but anyway, other economists have been have torn up bearish forecasts. You know, my belief was that prices would fall between 10 to 25%. And they did. In many markets, you look at Boise, you look at Austin, you look at Phoenix, these markets were down 20%. They've just started recovering. Now some of these markets are only down 5 to 10%. It's pretty incredible. But anyway, new listings of homes for sale are so low that bidding wars are still breaking out. Yes, in move-in ready properties, you're getting a lot of bidding wars for move-in ready homes. And it's another thing that we're consistently seeing is that move-in ready homes are more desirable for most home buyers right now, as opposed to like hoarding fixer-uppers or whatever, specifically because people don't have a lot of money left to actually do the renovations. And that's hurting people even more from being able to get good deals in real estate. You know, I teach in the Zero to Millionaire course how to actually do what I do to buy real estate. I think it's so jaded, but there are a lot of people that are like, oh, you know, somebody's not going to tell you their secrets. I literally tell you all my secrets. It's like, because I have an abundance mindset. There's so much opportunity out there. All of them are in the Zero to Millionaire course, which, by the way, we're bringing back our partnership with, I'm not allowed to say the name, but let's just say a big box retailer where we can now get 5 to 17% off the products we buy there for home renovations. It should be coming back this week, which will be a course member only benefit, which we're really excited about. And it's going to be great for House Hack as well, because we're doing a big fat discounts for House Hack as well. But anyway, another thing is interesting is that the pace of affordability for homes has actually deteriorated again. See, like, this is a chart here, and basically when the line goes up from the previous line, it means things are getting worse instead of better. And it means unaffordability is actually even getting worse now than it has been, and it's already been bad. And then that's because we've recently seen oil prices go up and rates go up higher. It's unfortunate, but it's exactly what's happening. Builders building more, but even starts not that great. What you're actually finding is more starts in 5 units under construction than single family. I thought that was somewhat interesting. Oh, there we go. Here's another chart, year-over-year change in median prices. This shows you that bottom right there in March to May. all right, March to May. And I waited for that inflection to really confirm itself. And then we started buying in August. So, maybe could have been a couple months earlier, but honestly, I think we're pretty close. And there's still so many deals to get. I mean, each of the deals we've bought so far has been, a home that people can't live in, hoarding homes, water leaks, whatever. And they're each going to be probably $120,000 wedges each. I mean, you're just plocking them up. It's kind of incredible. You could do it too. So anyway, these are some of the things we wrote down. But it's very interesting. The real estate crash that the bears are really calling for isn't happening here. I will tell you, though, where there is some pain. Oregon and Boise, there's pain. And the Airbnb market, and then obviously office space. So you have more individualized pain. Like, I'm seeing more institutions offload Airbnbs and short-term rentals and corporate rentals. And I'm also seeing more pain in certain markets, again, like the Boise's, and those may turn around, but some of the more COVID levels areas.